Imagine waking up in a country where the banks you trusted have suddenly shut their doors, where the money in your pocket is not enough to buy basic goods, and where rumors spread faster than facts. Now imagine that this collapse did not begin with a war or a natural disaster, but with a series of decisions, illusions, and miscalculations that almost no one questioned until it was too late. Most Americans today think financial crises began with the Great Depression or the housing crash. But decades earlier, long before the age of modern banking, the United States faced an economic disaster so devastating that it wiped out fortunes, destroyed political careers, and nearly tore the young nation's financial system apart. And the mystery is this: how did a country that believed it was on the rise suddenly plunge into chaos? Why did the boom of the early 19th century turn into one of the worst financial crashes in American history? The Panic of 1837 was not just an accident. It was the result of choices that seemed smart in the moment, but catastrophic in hindsight. And those choices look eerily familiar. To understand what happened, we need to go back to a time when the United States was still a teenager, a nation expanding rapidly westward, fueled by ambition, cotton, and the belief that growth would never stop. It was a world without a central bank as we know it today, without deposit insurance, without electronic transfers, and without nearly any of the guardrails we now take for granted. Money itself was a confusing concept. Instead of a standard national currency, paper notes issued by hundreds of individual banks circulated everywhere, each one backed or not backed by whatever that particular bank claimed to own. Some banks were responsible and cautious. Many were not. Some printed far more notes than they could redeem in gold or silver. Many printed notes backed by assets that barely existed. And nearly all operated with minimal oversight. Into this environment stepped President Andrew Jackson, a man who distrusted concentrated financial power, especially the Second Bank of the United States, which acted as a national stabilizer. Jackson believed it was a corrupt institution that favored elites, so he killed it, vetoed its charter, and pulled federal deposits. In the short term, his supporters celebrated. But in the long term, this decision removed the only strong national force capable of controlling banking excesses. Without the central bank's discipline, state-chartered banks exploded in number. They issued more and more notes, and America entered a credit-driven surge unlike anything it had seen. Suddenly, money flowed everywhere. Land speculation skyrocketed. Western territories that had barely been settled now saw buyers flipping plots like modern-day real estate traders. Cotton prices soared, and cotton was king, the backbone of Southern wealth. As long as cotton prices remained high, the system seemed unstoppable. But this rise masked fragility. Meanwhile, something else was building: a global imbalance. Much of the money Americans used was ultimately connected to Britain, the world's financial superpower. British banks provided enormous credit to American merchants, especially those dealing in cotton. And British investors, hungry for high returns, poured money into American projects. For a while, everyone benefited. But beneath the prosperity were hidden tensions: too much debt, too many risky loans, too many assumptions that the good times would last. And then came the twist. The government, worried that speculation had gotten out of control, decided to intervene. In 1836, the Jackson administration issued the Specie Circular, a rule requiring that federal land purchases be made only with gold or silver, not with banknotes. It was meant to slow down reckless land buying. Instead, it triggered a chain reaction. Demand for gold and silver, known as specie, soared overnight. Banks began to run low. People rushed to exchange paper notes for hard money. Banks struggled to keep up. And just as the United States was tightening credit, economic conditions abroad began shifting too. Across the Atlantic, Britain faced its own financial pressures. The Bank of England raised interest rates, hoping to protect its gold reserves. This made British loans to America more expensive and less available. Credit dried up rapidly. British buyers reduced their cotton purchases, and cotton prices collapsed. Because cotton was the foundation of America's economy, This drop sent shockwaves through the entire financial system. Merchants could not pay their debts. Banks that had lent heavily to land speculators and cotton traders found themselves suddenly exposed. And in the early months of 1837, the stress finally broke the system. In May of that year, banks in New York, the financial heart of the country, suspended payments in specie. These banks simply did not have enough metal to redeem their notes. Once New York fell, banks across the nation followed. People who trusted their paper money discovered it wasn't guaranteed. Businesses went bankrupt. Workers lost wages. Construction projects halted. Stores closed. Newspapers reported scenes of panicked crowds gathering outside banks, demanding answers. The nation plunged into its first major systemic financial crisis. But what made the panic of 1837 even worse was what came afterward. Instead of rebounding quickly, the crisis spiraled into a prolonged depression. The economy contracted and unemployment soared. Breadlines appeared. The price of basic food rose, while wages collapsed. States that had eagerly borrowed to fund canals, railroads, and infrastructure suddenly could not repay their debts. Several states, including Mississippi, Florida, Arkansas, Michigan, Indiana, and Louisiana, actually defaulted. For foreign investors, American finance began to look unreliable and unsafe. President Martin Van Buren, who had inherited the crisis from Jackson, struggled to respond. He introduced the independent treasury system to separate government funds from private banks. But this reform did not solve the crisis, it merely changed the plumbing of the financial system. Van Buren refused to bail out banks or stimulate the economy. He believed in limited government, and his caution deepened the pain. Businesses waited for relief that never came. Farmers watched their crops sell for pennies. Americans who once believed in endless opportunity now faced a reality where their savings had vanished. What is striking is how the crisis fed on itself. Falling cotton prices caused banks to fail. Bank failures caused credit to collapse. Collapsing credit caused businesses to close. Business failures caused unemployment. Unemployment reduced consumption. Reduced consumption made cotton prices fall even further. A negative feedback loop, familiar to anyone who studies later crises, locked the economy in a downward spiral. And because there was no central authority to stabilize the system, the country remained stuck in a depression for years. Even when a brief recovery appeared in 1838, it quickly vanished after more financial instability arrived from abroad. The worst effects of the crisis lingered until the mid-1840s, almost a full decade of instability. But what makes the Panic of 1837 shocking today is how closely it resembles modern disasters. The ingredients sound familiar: a burst of speculation fueled by easy credit, a sudden tightening of monetary conditions, asset prices collapsing, banking fragility, international financial contagion, and government responses that arrived too late or did too little. In fact, the crisis offers a window into patterns we still see. Consider this. Before the housing collapse of 2008, home prices rose at unsustainable rates, lending standards weakened, and people assumed the boom would last forever. Before the dot-com crash, investors believed technology stocks could only rise. Before the Great Depression, banks issued credit far beyond safe levels. And before 1837, Americans believed land, cotton, and expansion were unstoppable. What is even more interesting is how global financial forces influenced the crisis. In 1837, a decision by the Bank of England to raise interest rates destabilized the United States, much like how changes in Federal Reserve policy today ripple around the world. Economic historians note that when credit from major financial centers tightens, emerging markets and frontier economies often suffer first. In 1837, America was the emerging market. And the data, even by 19th century standards, was stunning. Cotton prices fell by nearly half in just 1 year. More than half of all American banks suspended specie payments. And unemployment in major cities soared to levels comparable to later crises. If you overlay charts from 1837 with charts from 1929 or 2008, The similarities are startling: sharp rises, followed by sudden, violent collapses. The Panic of 1837 also reveals something uncomfortable about human behavior. We repeat the same mistakes because the incentives never fully change. People tend to believe good times will continue. Leaders underestimate risks during booms. Investors assume someone else will catch problems before they spread, and when the system cracks, blame gets scattered. But the root causes are often visible in hindsight: excessive leverage, weak regulation, overconfidence, global imbalances, rapid credit expansion. When you strip away the details, the story is always the same. And that is why studying this crisis matters today. The Panic of 1837 is not just a chapter in economic history, it is a warning. It shows how a country can talk itself into a bubble, how decisions that seem sensible in the moment can create vulnerabilities, and how global financial shifts can hit a domestic economy harder than expected. Despite all our modern systems, we are still vulnerable to abrupt credit reversals, fragile banking structures, and sudden drops in asset prices. In fact, some economists argue that liquidity in global markets can now evaporate faster than ever before, magnifying the risk of sudden panics. And just like in the 1830s, we still rely on confidence, on people believing that the institutions holding their money are stable. So, what should we take away from this story? First, that financial systems are far more fragile than they appear during good times. The United States looked strong in 1836 until it wasn't. Second, that speculation becomes dangerous when it disconnects from real value. Whether it is land, cotton, housing, or technology stocks, the pattern remains the same. When asset prices rise faster than fundamentals, risk increases quietly. And third, that global financial links mean domestic economies are never isolated. Decisions made thousands of miles away can trigger collapses at home, just as Britain's tightening did in 1837. And so, the open question is this: if a crisis like the Panic of 1837 could emerge in a world with far less complexity, what could happen in today's interconnected global system, where trillions move in milliseconds? Are we better prepared, or simply more confident? History suggests confidence is rarely enough. If you found this deep dive into one of America's first great financial disasters valuable, make sure to like the video, subscribe for more finance history explained simply and powerfully, and turn on notifications so you never miss the hidden lessons behind major economic events. The past does not just repeat, it teaches. The real question is whether we are listening,